exclusive interaction with ET Now. HDFC AMC's Prashant Jain talks about the promising themes in the markets, if earnings are a cause of worry, and if the growth scare will curb the up move.
Corporate houses either are scared or they don't have the ability or the will or the scale to commit capital, because cycles start. Investment cycles will start when you have large corporate houses. They start investing a lot. I don't see that happening in any of the large sectors.
See, I think you need to divide potential capex by private sector in three areas. One is some businesses are fundamentally less capital intensive. Let's say FMCG or services businesses, and no matter what taxes you cut, they will not spend more because they simply are in that type of a business which needs capital expenditure. The second are the capital intensive businesses, and these are businesses like power, infrastructure, when you build a road, own a road, or metals typically. Now, unfortunately, in these three sectors, which drove the capex cycle in India last time around, many of the companies are in they have very difficult balance sheets. Many of them are under the bankruptcy proceedings. And the ones that are healthy, they would rather buy the existing assets under IBC, which are cheaper. I mean, if you look at all the power plants that are being sold or will be sold, they are nearly half of the replacement cost. So as long as existing assets are available to me cheaper, I don't think new capex will revive in the capital intensive sectors. I think this IBC process and most of the existing assets will find new buyers or new homes by March of this year. And I think post that, we should see private capex revive in these areas. And that's why I said earlier that the real opportunity for India in the near term is to get those 300 or whatever global companies into India. Because please appreciate, we buy a Samsung television, we buy a whatever mobile phone. If an Indian company puts up a TV factory or a mobile factory, we will not buy those phones. So our consumption basket, which is tilted more towards imports, we need to bring those companies in, and they can make for India and they can make for the world in India.
You're a firm believer of cycles. It's not that you've not bought consumer stocks in the past. And in 2008, 2009, one of your largest holding was Titan, followed by Page. Now you don't have consumer stocks in your portfolio. Why is that?
So I think, I don't subscribe to this view that good business is a good investment at any price. And that is not borne out by my experience over last 3 decades. So certainly we should buy a sustainable business, but beyond that, for a good business to become a good investment, the price must be good also. And I can give you several examples, like if you bought IT stocks in late 90s, early 2000s, for 10-15 years you made hardly any money because they were so expensive and future growth was discounted by 2000. If you bought FMCG companies in 1995, for the next 10 years there was zero returns, because they were so expensive in 1995. They were growing businesses, they were great businesses then, 95 and 2005 as well. So I think consumer stocks in India today to my mind, are trading at lifetime high multiples. Never before in my experience they have traded thus so expensive, and nowhere in the world they trade at even probably half the valuations. So I think while these are good businesses, sustainable businesses, but the expectations from these, to my mind, are unlikely to be met. And let us not forget that many of these are reasonably mature businesses. India sells 2 crore two-wheelers a year. And I think maybe in India there are 15 to 20 crore two-wheelers on the roads. So almost 2 out of 3 families own a two-wheeler. Soaps, shampoos, toothpaste, these are good businesses again. But to expect them to grow very fast, I think is not correct, because they are reasonably mature businesses. So I think we must I want to pay good attention to what price I am buying, apart from the sustainability of a business, and these businesses don't pass the valuation test.
But if one looks at the India story. It is perhaps, with the exception of Reliance, it is centered around consumers, autos, and private banks. You don't have a very large manufacturing company. You don't have anything very large which has become an export front company in terms of manufacturing. Why is that?
So I think that is true that because, I mean, it is hard to explain and probably unfortunate. In 90s, till 90s, India's per capita income was same or higher than China.
Is it true?
Yes. And today Chinese per capita income is 5 times of us. And I think while we made a success in the services industry and India dominates the world, but I think in manufacturing, China went decades ahead of us. And so if you look at the composition of the Sensex today, and you are right, that there are very few manufacturing companies in that. 30% is financial services, 20% like IT, pharmaceuticals, and oil and gas and metals. They are global cyclicals. So that is 50% of the market. Another 20% would be consumer discretionary, non-discretionary. That's 70, and there's only 10% is companies like Larsen Toubro. So you are right that and it shows up in our GDP composition. I mean, what is the contribution of manufacturing to GDP? But I think all is not lost. Today, Chinese wages are, for the first time in my career, in the last 1-2 years, Indian companies in chemicals, textiles, what else, auto ancillaries, they tell us, look, the wages or the cost of manufacturing in India is lower than China. That was not the case 15 years back. The compliance with environmental standards is improving in China. The subsidies are reducing. So India is now competitive in rupees terms. And that is why I think this tax cut has come at a very opportune time. That India offers the advantage. See, look at it this way. Our manufactured exports at 300 billion are roughly the same size as a Vietnam, Thailand, or Indonesia. And they are countries which are 1/10 the size of India. And China is 2.5 trillion. So I think given the right tax rates, given the right environment, and the advantage of a massive local market, which none of these neighboring countries have, I think it is reasonable to expect that many of these global multinationals who are present in China, when they move out of China or reduce their footprint there, India will get in future a higher share than what we have got so far.
So you mentioned the weightage of the Nifty. The weightage of the Nifty in 2000 was very different, dominated by TMT. 10 years from now, 8 years from now, what to your mind could be the face of the Nifty? Because that's why we'll understand that where wealth is going to get created.
So I think it has changed. In 90s it was very different. By 2000 it was very different. 2008 it was very different, and today it is very different. And it probably reflects both the economic growth and which sectors get undervalued or overvalued. Like tech, I vaguely remember in late 90s or early 2000 was almost half of the market weights. But it was reflecting as much the growth of the sector as the overvaluation, because these are market cap driven indices. I think, so let me comment on the growth. Where will growth come from? I think investments should outgrow consumption in India, clearly, to my mind. And unless you do that, it will be very tough for this economy to grow. Household debt in India has gone up very sharply. It used to be 2% in 2000. Today it is 20%. Our savings rate has dipped in last 10 years. In 2010 or 2008, our financial savings rate used to be 12%. Today it is down to 8%. Never before in India has our financial savings rate fallen. I think that is because the white collar wages have degrown. So I think the only way to fix this is to grow your investments. If investment grows, you create more jobs, it gives you more salaries, and then you can come back and spend. And again, most countries that have experienced rapid economic growth in the past, it has been driven by exports. So whether it was Japan, Korea, Germany, it has been China now. So I think when these global companies come to India, hopefully it will increase our merchandise manufactured exports as well. So I think in the future, businesses that will grow faster will be around capital spending, around manufacturing. And of course, financial services, I think, will keep pace with the GDP growth.
The recent downturn, which we have seen, and if I look at the quarterly numbers gone by, HUL has managed to grow, Bajaj Finance has managed to grow. Big companies are the only ones which are growing. Are we in an environment where the existing 50, 70, 100 companies will become giant companies, giant will become mega, and mega will become, monster?
So I don't think there can be any generalization to that trend. And we have seen in the past that there were, if you look at NBFCs, for example, many NBFCs pioneered a new area for credit. But over time, as that area became addressable by banks and as it became large, banks entered. And then they gained share back from the NBFCs. And I think the way, for the first time in this season, I think some leading banks offered you loans for very small consumer items. And today in India, you can get an EMI on a debit card as well. So I think over time, banks will be able to address the small consumer loans market because it will all be digitally delivered and they know their customers extremely well. It will be driven by analytics. So I think while those companies which continue to be ahead of competition, they will do well, and there is always space for companies which execute better. But I think banks will be formidable competition in the days to come, even retail, small retail loans. As far as Lever is concerned, it's a great company. It has outstanding brands, extremely well managed, global best practices. It continues to grow, it continues to premiumize. But Lever continues to grow at broadly the same rates at what it has grown for long periods. So I think Lever's business is reasonably easy to forecast, and where people have different views is what they are willing to pay for that quality and for that growth.
If I look at the track record of the fund which you manage, you've taken contra bets, not yesterday, not last year, but in your entire investing career. You bought stocks, you bought, for example, corporate banks when everybody was focusing on retail banks. You bought into PSUs when PSUs, in a sense, were not the popular trades in the market. You bought consumer names when there was a perception towards infrastructure. How do you come up with a thesis, an idea, and conclude that it's time to go contra? Are you buying it because they're cheap? Or are you buying them because you have compulsions of a fund manager? If you have compulsions of a fund manager, it's very easy to map the Nifty and stay with popular stocks. But you never do that.
So I am extremely non-violent by nature. So I don't believe in contra investing, but I do believe in value investing. And if value investing at a point of time means that you think differently from others, then so be it. So I want to, as I said earlier, I have always tried to buy reasonable quality businesses, not always high quality because sometimes they are very expensive. And I have always focused on what you pay for them. And it is quite logical that when a good business is passing through a challenging time, or when some other businesses are doing extremely well on the stock markets, and since most people in life, and I think in stock markets as well, are very short-term focused. They want to avoid short-term pain and get short-term gains. So when almost everyone wants to buy certain stocks in the markets, it is obvious that rest of these spaces tend to become more value. And if you are seeking value, if you participate in that part, then you become a contra investor. So contra is an outcome of seeking value, but seeking value is the key. And I'll give you 2-3 examples here. Around 99-2000, the IT stocks were trading at 300-400 multiples. And everyone agreed, even I agreed, that they will continue to grow for many, many years, which indeed they did. But it is just that more of that growth was discounted than the real growth. And so they were great businesses, growing businesses, but bad investments. And since everyone was buying IT and nothing but IT, almost everything else became so cheap, it is hard to explain. You could have bought BPCL in 2000 for just the value of the LPG cylinders. You could have bought Ashok Leyland for less than the working capital on the balance sheet. So that was one great example. And these businesses which grew slower, but they delivered far higher returns. Because if you buy something at 2 or 3p and if it goes to 15p, it is a 5 or 6 bagger. Around 2008, just the opposite happened. This was one time when quality was at a discount. So around 2008, you could buy the consumer companies, the pharma companies, the automobile companies in single digit or low double digit multiples. And we used to own Glaxo Consumer. They make Horlicks at 12p. I bought it at 18 and I saw it fall to 12p. And people used to tell me, look, Horlicks is had only by sick or by old people. There is no future to this business. Because that time, everyone wanted to buy only the infrastructure, the power, the real estate companies, because they were doing well. So I think I have seen this time and again that the definition of quality changes and what is in going up tends to get overvalued. But I must say that sometimes in the last few years, like you mentioned, corporate banks, we have been overweight. It can test your patience because when a business is in pain, it is cheap. And you are buying it in the hope that that pain will go away one day and that business is strong enough to survive that period of pain. And so this SR Steel case, it took almost 3 years to resolve. And we were hoping, given the IBC deadlines, that that resolution will take place much earlier. And that is why value investing can become difficult at times because something in the environment changes and the pain period gets extended. But the key is to buy a strong business so that it is able to endure that period of pain. And you should, of course, be able to endure that pain. And because in the end, if your assessment of value is right, no matter how long it takes, the value does unfold and the investment gives you the returns for the entire holding period.